Okay, gang, welcome to my videos, and I'm going to show you today with the stock market where it is. Everybody's looking at gold, everybody's looking at oil, and I thought I'd show you how we're going to buy these. We already caught gold, and I thought I would give you a little lesson in how to buy these things. First thing, though, you got to know is this, that the stock market right now, okay, where it is, and if you look at it on our chart right here, looking at our PT2 chart, if you look at the S&P, you can see in the last year, okay, and remember, green represents institutional money buying, okay, that's institutional money. That's Vanguard, T. Rowe Price, Northern Trust, Franklin Resources, J.P. Morgan, those kind of guys. That's when we know to buy, is when they buy, okay? And let me get rid of this, okay? And when they sell or take their money out, we know because we see it turn red, and then again, we'll know when they're taking their money out. Here you can see they put their money in, and the only thing you need to know when you're buying stocks, if you have is what we call a tight pattern, okay, like this one here, then that's very positive, and you really want to let your winners run, okay? Anytime you have the tight pattern, you want to let your winners run because that means there's great confidence. When you get a lot of volatility like this, that means the market's breaking down. You get these wide swings that we talk about all the time. All right, so, but remember, what pushes up a stock today is not a company, okay, manufacturing, okay, let's say a box right here, and then these manufacturers sell it to UPS, okay, to ship stuff. Now, again, let's just call this box company, and they make all these boxes. They send them to UPS, they send them to FedEx, and all these companies around the country. And let's say this company makes money doing that, but now let's say they make $1 million a year, okay, and then their stock usually, okay, every year they make $1 million, the stock goes up, okay, to $100, and every time after all their expenses, everything, they make $1 million, their stock goes up to 100. So they make boxes, ship them to UPS, FedEx, other companies. At the end of the year, after expenses, they made $1 million, and therefore the earnings, profits, people are going to come in and buy the stock and push it up to $100. Okay, so now the economy is not doing well. So now what happens is, instead of $1 million, what's happened is business is so bad, instead of $1 million, they only made this year $200,000. Okay, they made, it's still profitable, but they made, okay, they made 200 grand. I'll put it here. I don't want you to think it was in the red. So they made $200,000 this year instead of the 1 million, because they're three-quarters, they dropped their business by three-quarters. This is all the boxes they made, okay? So all this demand is gone. Demand is gone, and this company has laid off 500 people, okay? They laid these, and remember, it has what we call an effect, like a multiplier effect. So that's when people get laid off, then other people get laid off in your community. So it's usually about 3 times. So about 1,500 people got laid off in your community because this one company made boxes, laid off 500 people. All right, so I'm a stock buyer. I buy stocks, okay? So I'm going to go in, and all I want to make sure is, and again, what's happening is this. These guys over here on Wall Street, okay, they're going to lie to me. And these guys are going to lie, the government, with all their statistics, and CNBC, okay? CNBC is going to come in, and CNBC is going to lie to me too. What they're going to do is, so CNBC, they're going to tell us how the economy is really wonderful. Everything is just perfect. Everybody's in love with each other, and it's just a wonderful thing, okay? Even though they dropped their business. So how do they get the stock from 200 back up to 100 when they lost three-quarters of their business? Easy. Okay, what they do is Fed comes in, prints money right here, and then they give the money to the box company. Okay, so the money, here's the money, goes to the box company, and the box company goes out and he buys his own shares, okay? So stock buyback program. And so let's say the company had 1 million shares outstanding that was traded every day, 1 million. Okay, we use 1 million traded shares. They go out and they cut it in half. So this way here, when they cut their shares in half, that means that their earnings per share don't have to be any good, okay? They don't have to have good earnings per share, and they can make their earnings per share look a lot better now because they are spreading over they're spreading their profits. Let's say their profits now, remember I told you, is 200,000, so they're spreading profits over 500,000 shares instead of over 1 million shares. So by reducing this, buying their own shares, that their earnings per share, okay, earnings per share, they're going to pump earnings per share up, okay, that's going to give them a price to move back up to from, I'm sorry, say the price was at 50, the price is at $50 now. They're going to run it back up to 100 by Bernanke printing money. It's called QE. This is called QE. The box company is going to borrow it at 0% interest. And at that 0% interest, the company's going to go in and buy, out of their 1 million shares, going to buy half of it, cutting down to 500. So their profit instead of 1 million is 200,000. So what he's going to, by doing that, these 200,000 shares, going to spread it among 500,000 shares instead of 1 million. So my earnings per share, okay, is going to be just as good as it was when it was when we were doing $1 million instead of 200,000. So my stock will go right back up from 50 to 100 bucks. Okay, that's how they do it. It's that simple. There's other things they do, but that's the simplest way. That's what stock buybacks all about. Again, box company doing good, has 1 million shares, okay, or made $1 million, selling boxes to UPS, FedEx. Business went down, the economy went down, their profits dropped to $200,000, and their stock price went from $100 down to 50. So how do they get their stock price back up? Because remember, the CEO, this is the most important thing, the CEO, his compensation is tied to what? His compensation is tied to stock, okay? Okay, stock options. That's how he makes his money. The more the stock goes up, the more he makes. So his goal is to get the stock from 50 to 100. Now, remember, they laid off people, okay? They had, let's say, 1,000 people working. Now they only have 200 people. So he's not going to focus on new products. He's not going to focus on R&D. He's just going to focus on one thing, making as much money as he can. So all he's going to do is cut his shares back. He's going to go to the Fed, borrow money at 0%. He's going to go in and buy these shares that he had on the company over here. And let's say he had 1 million shares. He's going to buy them till they drop to 500,000 shares. So this 200,000 profit will be spread over less shares. And because of that, the earnings per share would be the same as if we was making $1 million in profit. Therefore, the stock will go up to 100 bucks. Pretty easy, isn't it? All right. So that's what's going on with these companies. And this is called what? Between here and here. That's called a bubble. This is a bubble. That's what bubbles are, see? So there, you have bubbles in the market. You have the tech, you have the housing, and now you got the QE. But then you have bubbles inside the bubble. You have a box company in here with a bubble, IBM with a bubble. They're all doing the same thing to create the big bubble. So what you want to be doing is making sure that you take advantage of this. You don't walk away from the market, because with the Fed doing QE and giving money to the company to buy their own share to bring it down, so instead of making $1 million, their stock can go up on 200,000 by cutting the amount of shares they own. Spreading out their profit over fewer shares brings up the earnings per share, which brings the stock back up to here. So we're fine. As long as you know that's what they're doing to make money, they're no longer, and remember, their plants are empty. He's not making big, he don't care about that anymore. Okay? He's going to keep doing this for years and years. As long as quantitative easing, he can keep doing this. So you should be making money on it doing the same thing. Okay? And what you're going to do is every stock that you buy, it's very simple. You want to make sure on a pattern the stock has a W formation. That tells you that institutional money is coming in. Okay, anytime you buy a stock, it's got to have a W formation. Okay, as long as it's got a W formation, okay, anytime it's got a W formation, okay, all right, let me find you, like right here, see this W right here? There's a W right here, and see here's a W right here. It's the only time you buy, when you got W's. That why? What does a W tell you? A W tells you the institutions that own this share. Let's say it's owned mostly by BlackRock, T. Rowe Price, and Northern Trust. Well, we can tell if money's coming in when it's got a W, okay, if we're trading a short period of time. Then we know it's got enough money. I mean, it's got enough money coming in to push the price up. We're on the right-hand side of the W, right here, the right-hand side of the W here, you have this pattern called a springboard pattern, sorry, okay? Or you got another pattern, there's only two, and it's called the retracement engulfing. They're always right on this side here, on the right-hand side. So, and as long as you have a W, it signals money coming in, and as long as you have these two patterns show up on the right-hand side, it's telling the pricing power is going in and it's going up. But, you don't even need to know that. You want to know the easiest thing to do? We designed a neat chart, okay? And we designed what we call our PTT2 chart. All you have to know is one thing. You want to know that the color is green, you buy. And this red line crosses the yellow. That's all you want to know. And if it's going to come down, if the institutions, if T. Rowe Price or BlackRock or Northern Trust going to take money out of this company, then all you know is when it turns red, you check down here. And if this is crossing over this way, you know they're pulling money out and we make money shorting it. Okay? When it crosses up this way and it turns green, we buy. That's all you need to know. Technology today is wonderful. That's why you should buy our PT2. Join the gang. Learn how to use the PT2. And you can sleep at night. You will always be ahead of what's going on. You don't have to call your broker and say, hey, what's going on? What should I do? What should I do? Should I buy? Should I sell? Should I get out? No more. You can throw your broker away because it's right here. Technology does it. And it's voice activated. My voice tells you when to buy and when to sell. So now you understand how stocks, again, as I say, a company, once again, their business goes cut in half, their box business cut in half, okay, from $1 million profit to $200K profit, okay. Their stock dropped from $100 down to $50, okay, and they want to get, and the stock, remember, went from 200 to 100, $50 a share up to $100 a share, okay. And how do they get that back up there with the business cut by 3/4? Simple. Remember, Bernanke printing money, and then all they do is take those shares. Let's say the company has 1 million in shares. They're going to buy those shares, cut them in half. So they have 500 shares. And so the earnings per share they need, they're going to come in and they're going to buy, cut the amount of shares to half. That will push the earnings per share up to move the stock price back from, let's say, from $100 right here to $200. That's how it works. So that's how they make the price go back up, cheating. And you want to know when that's happening, and you're going to know that over here on the chart. So very simple. This is not complicated. Okay? So when you hear a company's stock is getting hit, okay, or their earnings are going down from 1 million to 200,000, don't worry. And if you know the stock went down from $100 down to 50, we know that's opportunity, because we know the CEO wants to push that stock right up. Why does the CEO want to push it up? Because his compensation is tied to the stock. So he's going to push it back. He's going to push it back up there, and he's going to push it back up, even though business is cut in 3/4. Because he's just going to go, again, borrow this money. Here's the money being printed. And he's going to go in and he's going to buy the 1 million shares, going to cut it down to 500,000 shares. That means the profit of $200,000 is going to be spread over less shares. That means the earning per shares are going to go up the same as if he was making $1 million. And the stock price will go up, same as making $1 million when he's only making 200. See how it works? So that's why you'll never see QE. They raise interest rates. the 1 percentile or the 10 percentile, actually making so much money in the stock market. 6 years, the market's been around 97 years. We've never seen before in 97 years a market do this where it goes up straight for 6 years every year like this because of QE. So enjoy it and make money with it. You just need the right tool, my PT2. See you on the charts.